Hey, this is Don Kaufman, and you are watching the TheoTrade Weekend Update for July 28th, 2018. Where to begin? Nice size bifurcation in this marketplace kind of late in the trading week. Effectively, what am I saying? The S&Ps ended up on the week. The Nasdaq ended down in the week, and the Russell was actually under some fairly serious duress coming into Friday's trade. With that, let's just do a quick recap of some of the action of this previous week. Of course, we'll talk about tech. We'll even throw a little Facebook in there. And we're going to move forward. We're actually going to look out, of course, to next week. And one of the themes of this video, and for those of you that speak a little bit of option geek, implied volatility right now isn't giving this marketplace any respect for some of the risk that might be looming. Think about that for a second, because it's going to be to your advantage to understand that concept during the course of this video. All right, quick recap. So earlier in the week, again, we had some earnings announcements. Obviously, Facebook comes in, whacks everybody by surprise. The stock actually trades from the 200 range and the lower 200 range and snaps all the way down to the 170 handle, loses $120 billion of market cap. Again, to put that in perspective, it's like losing Netflix. That's how much market cap it actually lost in such a brief amount of time. Enough said on that front, other than the fact that I think the marketplace as a whole handled it quite well. I mean, we just lost one of the monsters of tech, right? And it really didn't have this wild and drastic impact on the Nasdaq like we may have expected. Nevertheless, the marketplace kind of turned a bit of a blind eye to that, and that's exactly what I'm going to point out here. This is something we may be able to take advantage of in the coming trading sessions. So tech reverses a little bit. In fact, on Friday, we saw wild sell-side activity, right, throughout Amazon. Now, Amazon releases stellar numbers, record earnings, reverses throughout the course of the trading day, ended up on Friday mildly. But this is something you have got to be literally edge of your seat watching in the coming trading sessions. And I'm already done kind of recapping some of the action last week. It's ancient history. We got to be forward looking. We got to take advantage of some of the opportunities that are going to be afforded to us right here, right now. And what that comes down to, and what I'm going to show here momentarily in a couple of the charts, is IV ain't got no respect for this marketplace. What does that effectively mean? Let me give you a quick example on this front. If you were to take a look at a product like Netflix, of course, Facebook lost to Netflix, but let's look at Netflix for just a moment. And again, we're going to show this on a chart here in just a few minutes. Netflix, after the earnings announcement, drops fairly substantially, and yet the implied volatility also has dropped. Now, that's what you would expect after an earnings announcement. You would expect the implied volatility. And what is implied volatility? It's how options are kind of dictating movement in the marketplace. It's how options are gauging risk. So what they're saying in Netflix is, earnings are out, risk is off, don't worry about risk. But the implied volatility, has already dropped down to about 30%, which is fairly shocking given the intraday movement on Netflix on a day-to-day basis. But wait, there's more. If you take a look at the SPX, which again, we're going to look at here momentarily, and we look at kind of week in, week out, we look at what's called expected move. The weekly expected move in this previous week was about $32, right? $32 expected move. First and foremost, the expected move the previous week got breached to the upside, then the market sold off on Friday, taking us right back into the expected move. But again, it was a $32 expected move. We see some fairly wild trade on Friday, right? The S&P futures ended down just about 25 points. Yet the expected move for all of this coming week, this is taking us into like the first week of August. Why is that important? Because there's a jobs number at the end of the week, right? So jobs number is coming out at the end of the week. You know what the market does? Stares at it, laughs. Why? The expected move in this coming week is only $34. You got to look at that and you go, what? How could it only be $34? We just moved 25 bucks in a day. Think about it. Take advantage of it. You want to be on the buy side of options throughout the course of this week. And I'm going to reiterate that time and again, because everywhere we look, IV ain't got no respect. Go take a look at the Russell. The Russell right now is sitting somewhere in the neighborhood of about a 16% implied volatility. Specifically, if you're not into the Russell, look at the IWM. The IWM moves $3 on Friday. Moves $3. That was yesterday. Okay, in one trading session, actually a little bit over $3, and this entire next week is only pricing in a $3 move. How could you not want to take advantage of that? Whether you're buying calls, whether you're buying puts on an intraday basis. For those of you that speak, again, option geek, you need to be long gamma, okay? Buy gamma, love gamma. This is going to be, though, for a very, very short duration burst in the marketplace. Last but not least, before we get into some of the charts, we had some really great earnings and earnings related trades. Not necessarily great earnings, but hey, the trades worked out. We've actually had really great trades on Microsoft. We actually hit a Microsoft butterfly on the earnings. All right. We did a sizable bearish trade in Facebook. It worked out. We did a bearish trade in Amazon, and that one we got out by the skin of our teeth late in the day on Friday with some sell side activity inside of Amazon. And hey, have no fear, we're going to be back and we're going to be trading Apple, of course, this coming week. For those of you unaware, Apple's going to release early in the week, but Apple lately has been really lackluster. However, we're actually going to be looking at Apple for a number of trades, including, again, these kind of butterflies to the edge of the expected move. With that, let's get right down to specifics. Let's go into the charts here and take a much more detailed look at some of this, what I would call low implied volatility in a time of high risk. Let's get right to it. All right, let's get to the charts and let's begin our discussion right here in the SPX. Now, I've made a couple of bold statements in the video portion of this about buying premium. Let me kind of qualify why I'm talking about buying options premium, especially on an intraday basis. Now, first and foremost, I recognize that not many of you can necessarily trade on an intraday basis. I'm not asking you to sit in front of your computer all day long. I'm just asking you to respect the fact that the marketplace is moving, okay, far more in many of the trading days than is anticipated by implied volatility. And I can't stress to you enough, the move this past week was supposed to be plus or minus about $32. Well, did we do it? Yeah, early in the week, here's Wednesday, we actually shot outside of the expected move. And then, of course, later in the week, we came back in it. But the point being, look how violent a couple of these moves are. And if you look at just Friday's move was right around $18. And you're like, okay, so how am I going to make any money off of this? Well, let me give you just a prime example here. So I'm gonna close up this left side bar, and I'm just gonna take us back a trading day. All right, and I'll kind of take you through a little bit of example, but here, the trading day I'm taking you back to, it's Thursday afternoon, right? Thursday afternoon, and I want you to look at the expected move over here on the right-hand side of your screen. It's about $13. Now, let me give you just kind of a brief example. Now, you don't necessarily know whether the market's going to rally or the market's going to sell off, but I'm going to tell you, directional bias is secondary in a marketplace that's capable of moving more than expected. I cannot stress this enough. Directional bias, okay, is secondary in a marketplace that can move more than expected. I'll give you a quick example, right? Let's say that you could be right just 50% of the time. Blindly, you wake up in the morning and you buy calls or buy puts. How do you decide? I don't care. You flip a coin, right? And if you're right, you're going to make X amount. If you're wrong, you're going to lose X amount. I'll give you a quick example. You could have woken up on Friday morning, right, and purchased these options right here. That's the 1835s, and you could probably buy them. Let's just be really fair about this market. Let's say you got them for $3.50. So you went out and you purchased these for $3.50. Now, we didn't know that that was going to work, okay? But you can go out all throughout the course of the week and do similar trades, and I'll risk 350 here and risk 350 here, and I'll risk 350 here. So you risk 350, once, twice, 3, 4 times. And on the 5th time that you did it, okay, that 350 turns into what? I don't know, 18, maybe even as much as $20. You're like, well, how exactly does 350 turn into $18? Because the marketplace moved far more than it was anticipated to move. Take a look at the SPX. It actually closed down at 28.18. These 28.35s, okay, how deep in the money were they going to be? 16, 17 bucks? Okay, that's a home run. It's an absolute home run. And that's the point that I like to make. You have to strategize trades more than think about like the bias. You get the bias right, you're gold, Jerry, gold. But the bias in this particular circumstance isn't as important. And that's something that I want to really lace into you on this particular video here is I see it all over the place. Let me give you one other example. Go take a look at the IWM, which happens to be the Russell. Okay, it's the iShares, it's the ETF version of the Russell. And this one really sticks out to me, just sore thumb. All of next week, the Russell is expecting a $3 expected move. All of next week. Like look at the options, right? We're trading right around 165. So it's these 165 kind of calls and these 165 puts. Those are the at the money options. In fact, one thing you can kind of do, take the at the money call, add it to the at the money put. Okay, and what do you get? $2.72. Do you realize the straddle will trade for $2.72? Now, I'm not indicating you need to necessarily buy a straddle, but I just want to show you the straddle for the entire week. All right, for the entire week is right there. That's what? Less than $3? Okay, less than $3. We move more than $3 just on Friday. That's the point that I'm trying to make. Option premium right now isn't giving any respect to this marketplace. We also see it inside of Netflix. Let's zoom out here for a second. Go look, okay, at Netflix and respect the fact that this thing has dropped all the way back down to like a 30% implied volatility. Yet it's still seeing $7 and $8 moves on a day-to-day basis. Those are wild moves. Like in any respect, those would be fairly wild moves. And that's one of the things that I want you guys to really think about on a week-to-week basis. People are struggling. They're like, I got taken apart trading futures. I got ripped apart trying to get directional in my swing trade. All right, you know what? Why don't you go out and buy some premium, early on in a trading day, do nothing, okay? And hey, maybe by the end of the day, the thing could be huge. And that's exactly what we've been doing. Now, as I said, we've done a couple of earnings trades in Microsoft, and we hit a butterfly in Microsoft, in the previous week. We've actually done earnings trades inside of Facebook. Facebook, I had two different earnings trades on. I had one straight out bearish position, which was an absolute home run. And then, of course, we also had a butterfly. We missed the butterfly in Facebook, but that doesn't really matter since we only paid about 15 cents for it. But we hit the spread out of the ballpark. Okay, in Amazon was quite entertaining because in Amazon we had a spread that literally came down to like the last few minutes of trade. You're like, it was a bearish trade. Okay, even though the product ended up. Okay, there were periods in the day where if you were unaware, go to some of the intraday trade. Our spread, okay, we actually went fairly deep in the money, so we got out of that thing not only alive, we got out of it profitable. A bearish trade taken in Amazon and got out of it profitable. Now, kind of the big question here, and again, I'll do an Apple trade as we come into early next week. I think it's too early to try to handicap what this expected move is going to look like. All right, but I think in a larger sense, we need to talk about just the marketplace in general for a few moments, because having seen some sell side activity, specifically in the S&Ps, and we came right up. This is a line that we've had on our screen since, the January timeframe. This is 2842, having come literally to 2842. I mean, people on the button. These gravity points have been excellent for us. We came right to 2842. We actually reverberated back down. Question you've got to ask yourself is there going to be any sustainability to the sell side activity? And I don't mind saying this, but right now, right here, the volatility says, no, this is not much is going to happen. I don't mind saying that. Like the volatility right now is telling us that, well, this marketplace kind of sold off. I'm telling you, S&P is down 25 and the VIX shrugs. Oh, it's up 7%, but that's nothing. It's absolutely nothing. People, we haven't seen any sell side activity in weeks. Okay, so we get a little sell side activity. The marketplace literally shrugs its shoulders. Now, I look at that again as I want to take advantage of it because I think some big moves are going to come. But I think everybody wants me to say, like, is the market going to fall? You want to know if the market's going to fall? First of all, you don't need to look specifically at tech. You really don't need to look. This is the monsters of tech. It's a conglomerate symbol, right? It's Facebook plus Apple plus Microsoft plus Google plus Amazon. Thing got rocked. on a year-to-date percentage, and I really want to zoom into this for just a second, but on a year-to-date percentage, here we are up, let's call it 28%. Where do we close? Right around 20% or 21%. So what did we lose? Right around 7%. So we took a little bit of a hit of about 7%. But a 7% hit to the monsters of tech, again, they shrugged off, and I'm saying the marketplace really shrugged off some of the news from Facebook. They're like, it just happened in Facebook, big misunderstanding, and the market actually stares and continues moving forward. Because in the exact same time, and I'll put this up on a year-to-date percentage, the exact same time, how impacted was the S&P? And again, I think it handled it quite well. The S&P still ended up on the week, literally ended up on the week after all of that. Why? Here we go again. Financials. The financials have been bid. The financials have been ripping. Now, on a year-to-date basis, the financials are completely unchanged. They're completely unchanged. But the key point is, it's the financials that not only rallied, but it's the financials that sustained the entire marketplace, especially in yesterday's sell-side activity. Do you recognize, the S&Ps were down 25, but the financials slightly bid. You ain't going to see that too often. That's some pretty wild activity, where the Nasdaq is down almost 2%. But it's okay because the financials were bid ever so slightly higher. So long as the financials are strong, S&Ps, they're not going to crater, which is exactly why, if you want to take advantage of some sell-side activity, right here, this is the product. Now, I've actually stepped in, and I am starting to trade and probe in terms of the financials. I've got a number of bearish spreads on. One of them happens to be an in-out spread. It's the 29.27 in-out spread. Now, this is a fairly wide in-out spread. It's $2 wide in-out spread on a product that can only move about $1. Nevertheless, it's going to give me some nice downside opportunity if the financials are to break. Why am I looking at this? All right. The financials have ripped to the upside. And why am I not just getting bearish, for instance, in the S&Ps? First of all, I don't know necessarily if the S&Ps are going to sell off, but I do know one thing. The financials have had an absolute, fiesta to the upside over here. And in respect to the entire marketplace, if the marketplace is going to break, it's the financials where I'm going to want to be, because these things will actually come rocketing right back down to this 2650 level. Hence why I actually put the trade on in the financials and not necessarily the S&Ps. Throughout the course and early in this week, also, you really want to be looking at technology. There's no question about it. But you got to have respect for the fact that technology could completely come apart at the seams, but it's still up to financials whether the S&Ps are going to break. And right there, that's why I'll kind of summarize. That's why the VIX didn't take off to the upside. That's why volatility didn't spike. Why? Because the financials laughed off. It just laughed it off. I mean, if you take a look, and this is something I, hadn't even planned on getting into in this video. Nevertheless, if you take a look, and I'll leave you with one last thought, at the S&P 100, you realize the advanced decline line. Again, these are things that you're just not going to see. You're just not going to see this in a marketplace often. The advanced decline line in the S&P 100 yesterday, but the S&P is down 25, quite spectacular. It's almost a 50-50 in here. It was like the marketplace just didn't care. We still sold off 25 because tech was getting absolutely slaughtered. But just to prove a little bit of point, we don't have correlation. And this is where I really want to take shots in the marketplace, big shots in the marketplace. You're like, well, why? Could you imagine how the market would have moved had this been correlated? If the financials were selling off with, for instance, technology, the S&Ps would have been down 70, 80, 90 handles. Want to look for correlation? We want to look for what the financials are going to do earlier in the week. Therein lies. Once again, I've talked about the financials being kind of the linchpin in the marketplace. Therein lies, the product right now that really matters the most. We've seen tech, start to get decimated. Financials are holding us together. Thanks everybody for joining us here at TheoTrade for this weekend update. Have a wonderful weekend. Bye-bye.